All right. Today is Thursday, March 11th, and this is a post-market review for the stock market activities today. The summary of the action today was we heard some news from the ECB overnight indicating that they will be increasing their bond purchasing program, and as a result that contributed in pushing yields lower overnight. And we know the problem that is going on in the market right now. The rise in treasury yields is making technology and growth stocks look unattractive, and therefore the algos had been programmed to follow the movement between the 10-year treasury yield and the Nasdaq. And as you can see, the correlation is very, very high. And we are seeing changes in the bonds market that we haven't seen before in regards to the stock market. As you can see, the trajectory for yields the last 40 years was downtrending, and that is all what the market needed to continue to rally higher and higher and higher, specifically for technology stocks. What we are witnessing this time around is quite different because yields are trending higher once again, made a double bottom, and now starting to rise once again hand in hand with the improvement on the picture of the economic recovery after the vaccine. Yields are also rising due to high inflation expectations, reflecting on all the fiscal and monetary liquidity that hit the financial system. And as yields rise higher, we notice that the Nasdaq is downtrending, moving in inverse action to yields, meaning that if yields continue to rise higher, the trajectory for the Nasdaq is lower. And we know that both tailwinds supporting the rise in yields are here to stay. Number one, the economic recovery, and number two, the rise of inflation expectations. Until and unless you address these tailwinds pushing yields higher, you're not going to be able to reverse the higher trajectory, meaning that keeping the Nasdaq elevated is a tough task. And you saw as yields started to rise, the last couple of weeks, we saw a massive sell-off in the Nasdaq and in growth stocks. But as yields started to moderate and settle down this week, we saw the Nasdaq bouncing higher significantly. So what is behind the stabilization of the yield curve this week? Remember, two tailwinds pushing yields higher. The economic recovery. Number one, did we negate anything regarding the economic recovery? Absolutely not. If anything, we poured more gasoline on the fire with the new 1.9 trillion stimulus. Okay, what about tailwind number two? The rise of inflation expectations. Anything happened this week to curb inflation expectations? Well, number one, the cooked CPI or CPI number, but that didn't push yields a lot lower, but it definitely had an impact in putting a cap on the velocity of the move higher. It pushed the brake on the surge of treasury yields. Likewise, what we got today from the ECB, which was in coordination with the Federal Reserve, by the way, is also yet another tool to artificially intervene to keep yields from surging higher, meaning that all of these efforts are band-aids. And so long as the two tailwinds pushing treasury yields higher, the trajectory is that we will resume the move higher impulsively in the 10-year treasury yield, and that in turn will push the Nasdaq lower. So are we bouncing higher in the Nasdaq this week and we are seeing the stabilization in treasury yields? Is this happening only due to the manipulation of the Federal Reserve? No, not at all. The manipulation is a factor, and I would argue a failed factor, because even after the cooked CPI and the move from the ECB this morning failed to push yields below 1.5. But there's another thing keeping yields lower and pushing the Nasdaq higher this week. The technicals, meaning the oversold conditions in the market, specifically in the Nasdaq and the growthy names. So what are you trying to say here, Maverick? Here's what I'm trying to say. We will revert back to the same scenario that was going on the last couple of weeks of yields surging higher and the Nasdaq trending lower Once again, unless the two tailwinds pushing yields higher, the economic recovery and the rise of inflation expectations are removed out of the picture. And we know that's not going to happen, meaning we are now in a dead cat bounce period in the Nasdaq and the growthy names, not necessarily in the Dow Jones, the S&P 500, industrials, financials, etc. These names are thriving from this environment. We are talking about the Nasdaq. Okay, so you're saying that this bounce is temporary. So who is doing the buying to fix all these technicals, the oversold conditions? I have that information for you, and we will cover it during the headlines of the day's segment. And here's a spoiler alert. It is a combination of algos and short covering. There wasn't that much of any retail participation or any legitimate buying, further solidifying that the trajectory here is yields higher, Nasdaq lower. So be careful here chasing any of these moves higher. That doesn't mean that in certain names we're not going to see higher prices, and we will discuss those in details. But be careful of separating a trade versus an investment, thinking that you are buying the dip at a good price. We'll talk about that and a lot more during the headlines of the day segment and the charts analysis. But for now, I got a market to cover, and here we go. The Dow Industrial Average closing in the green by 188.18 points, or a gain of 0.58%. The Nasdaq closing in the green by 329.84 points, or a gain of 2.52%. The S&P 500 also in the green by 40.49 points, or a gain of 1.04%. And what about the sector's performance for the day? Leading the pack at number 1 and capturing the gold medal, technology; at number 2 for the silver, communication services; and at number 3 for the bronze, consumer cyclicals. Meanwhile, the laggards of the day led by utilities, financials, and consumer defensives. Pretty much everything was trading in the green today, but led by the deflationary side of the market, technology and communication services. And the reason is we saw yields stabilizing, even though today yields were surging higher from the bottom, which is very interesting here, and perhaps a canary in the coal mine. Again, what is contributing to yields surging higher? The rise of inflation expectations. What is contributing to the rise of inflation expectations? The rise of commodity prices. What is contributing to the rise of commodity prices? The tsunami of liquidity and the uneven recovery in the world. Asia recovering faster than Latin America, Europe, and America. And therefore, when we talk about the outlook for treasury yields, we have to look at the futures market and see where commodities are trading. And for that, we're moving on to the futures market performance. And here it is. Crude oil back in the green. Brent almost closing 3% in the green, getting very close here to a rating of 70. Likewise, the WTI surpassing 66 and closing with gains over 2.5%. today. What about softs? The laggard was lumber, closing in the red. Meanwhile, we saw gains here led by cotton, sugar, OJ, coffee, and coca futures. What about metals? Muted action for gold, silver, platinum. Meanwhile, copper back in the green, surging higher once again. Palladium joining the party with copper. What about meats? Lean hogs futures. To the moon, bro. Another day and another massive gains for lean hogs. Meanwhile, modest losses here for feeder and live cattle futures. What about grains? Mixed picture led by gains from soybean oil futures and declines from wheat futures. The rest, soybeans, soybean meal, corn, rough rice, oats, canola, traded muted for the day. Moving on to the big casino, the options market, and let's see what's going on here. Once again, we talked about the bounce being algorithmic in nature, coming hand in hand with short covering, meaning that the retail trader is not involved in this bounce. Maybe some are chasing the moves higher by buying calls, but all in all, there is no retail participation in this bounce. What does that tell us? It tells us that retail is either all in, they already bought their stocks, or they lost significant amount of money during the last couple of weeks when the market traded lower. And the $1 million question here is, how will the new stimmy impact the options market? Will we see a pickup in volume right away? We know that the bill passed and the checks are coming over this weekend, so that would be very interesting to watch. Do retail traders need more ammo, and will the stimmy offer that ammo? Because for now, we got muted activities in the casino. But regardless, finishing at number 1 and leading the pack, Apple, with a little over 770,000 contracts. About 69% of those were calls. At number 2, GE, General Electric. Big declines today, and we saw an uptick in volume. About 450,000 contracts exchanging hands today. 64% of those were calls. And at number 3, NEO, with a little over 400,000 contracts. About 65% of those were calls. Where is Tesla? Barely made it, not even in the top 5. And that tells you once again, the massive bounce we saw in Tesla is algorithmic and short covering in nature. Nobody is buying the dip. Nobody is buying call options to push this name higher. Now, will the stimmies change the picture? That remains to be seen. But for now, that tells me that the bounce in Tesla is not sustainable once the short covering and the algos fix the oversold conditions. Moving on to the unusual activities that took place in the options market today, starting with the ticker QEP, and this is for QEP Solutions, an oil and gas company, and somebody's bidding for massive gains here by buying the $5 strike, expiration date April 16th, with expectations that the name will gain over 14% by then, and they paid about 40 cents a piece to enter this trade, bringing the total all the way to $1 million. And what about the trade for the ticker Triple Qs for the NASDAQ? Another bearish bet here, expecting the resumption of the declines by buying the 301 or 301 puts expiration date April 1st, with expectations that the NASDAQ will decline over 5% by then, and they paid about $3.50 to enter this trade, which brought the total all the way to $3.5 million. What about the trade for the ticker EGHT? This is 8x8, a software company, and somebody's making a bullish bid here, a very interesting one, by buying the 40 calls, expiration date April 16th, with expectations that the name will gain over 13% by then, and they paid about $1 a piece to enter this trade, bringing the total to about $1 million. What about the trade for the ticker BABA for Alibaba? Alibaba has been hammered severely the last few weeks, right after we heard the news about Jack Ma and the whole fiasco with the government over there. But now, are we starting to see the light at the end of the tunnel? Meaning, there was an article in the journal today, and I am paraphrasing here, but the headline reads, China plans to move with Alibaba without Jack Ma, meaning that the Chinese Communist Party is thinking about how to involve Alibaba as a company in the Communist Party's business without Jack Ma. Take Jack Ma out of the picture, make Alibaba more associated with the government. Now, that could have bad implications for Alibaba from a regulatory perspective, at least here in the United States. But that is a long outlook, and a problem we're going to have to face down the road. For now, perhaps the scrutiny is over, since Jack Ma is out of the picture. At least this is what this trader is betting on. By buying the 262.5 calls, expiration date April 1st, with expectations that Alibaba will gain over 9% by then, and they paid about $2.65 a piece to enter this trade, bringing the total to about $2.5 million. Now, what about the trade for the ticker VNet? They're buying the 38 calls expiration date April 16th, with expectations that the name will gain over 7% by then. They paid about $2.45 apiece to enter this trade, bringing the total to about $2 million. What about the ticker GME for GameStop? The GameStop mania took a break today, and I believe that helped the markets to surge higher. They don't have to worry about GameStop ruining the show. But are we going to start to see yet another massive move in GameStop? This is exactly what this trader is bidding on, because they're buying the 195 puts expiration date March 19th, expiring next week, with expectations that GameStop will decline over 25% by then. They paid about $28.50 a piece, a big price, bringing the total price tag to about $17 million, a big one. And what about this last trade we're covering today for the ticker VXX? This is a proxy of the VIX. Very interesting bet. Buying the 17 calls expiration date April 1st, with expectations that the name will gain over 19.5% by then, and they paid about 55 cents a piece to enter this trade, which brought the total to about $330,000. Moving on to the headlines that shaped the day, starting with macro news. We were anticipating the weekly jobless claims to come up in the morning, and here's what we got. Breaking weekly jobless claims total 712,000 versus 725,000. That was the expected number, meaning slightly better than expected. And 700,000 is a lot better than the numbers we were getting the last few months, 800, 900,000. So there is an improvement, as slow as it may be. And remember, the market does not like good news. And when I say the market, specifically the Nasdaq, but the overall market included, because good news contribute to one of the main tailwinds for the rise in Treasury yields, the acceleration of the economic recovery. But rest assured, in the meantime, if you are worried about the rise in Treasury yields, the Fed got your back. Remember when the Fed got your back the first time and then stabbed you? Well, they're now hoping that you forgot about it, and they are telling you, we got your back this time around. Jerome is saying, get back, don't run out of the casino, come back over here. Papa Jerome got it. Put your blindfold on, sit at the blackjack table, and double down even though I'm showing an ace. And by the way, I'm not offering any insurance. Of course, you would be a sucker to go back to the table and sit down and play with Jerome, because whatever he's doing behind the scenes, it is only temporary. And if you continue in this journey, believing that the Federal Reserve is actually in control, you get another thing coming for you. Because once again, the conversation goes back to the beginning. Two tailwinds: the acceleration of the economic recovery and the rise of inflation expectations. None of those were addressed at all. So they remain in the picture, and they will continue to push yields higher. But in the meantime, here it is. We can party for a little bit with our blindfolds on, because the ECB came out in the morning and said we will increase our bond purchasing program over the next quarters significantly faster. And right away, you saw the futures blasting higher. That's all what the futures needed, because yields started to get crushed on the head. Here's the problem. As we started trading in the regular session, the indices started moving higher, but so did yields, closing above 1.5 once again. So be careful trusting Jerome to have your back, because he got a big knife hiding in his pocket. And why are central banks so nervous about the slight increase in yields and interest rates? Shouldn't we be celebrating yields going higher because they're rising due to the quote-unquote good reasons? Why do we have to panic? Why do we have to take measures to curb yields lower if yields are rising higher due to the quote-unquote good reasons? What are you so nervous about that you have to manipulate yields lower even though we're only reading 1.5%, which is historically very, very low? Here is reason number one. The world's debt hit a record 201 trillion at the end of last year, equal to 267% of GDP, with a recent surge in issuance possibly causing corporate defaults to rise to the highest levels in more than a decade. We got zombie companies, zombie economies, and the slightest rise in treasury yields could threaten the destruction of many zombie companies and zombie governments. Reason number 2, US budget deficit hits a record of about $1 trillion after only 5 months. Could reach over $4 trillion this year. We have to keep the machine greased. We have to keep the machine printing over and over and over again because we got no choice. We're certainly not going to increase taxes, at least not right now. We're going to have to down the way, but for now, we have a massive budget deficit and we need more printing. Therefore, the rise of interest rates, even the slightest bit of rise, will threaten the whole operation of this dead zombie government. Here's another reason. S&P 500 real earnings yield continuing to fall, now at the lowest since late 2008. What does that mean? It means that as yields continue to rise higher, the stock market will start to look less and less and less attractive, threatening a market correction or market crash, perhaps a very steep one given the current valuations in the market. And therefore, central banks have to continue, in this case, the Federal Reserve, to grease the market higher at any cost because they know if yields get out of hand, we will see a destruction in the stock market between the bankruptcies and the sell-off. And the Federal Reserve is very, very careful not to cause a financial crisis in the markets while we are still recovering from the economic destruction of the COVID-19 virus, because a crash in the market will certainly spill over into the so-called recovering economy, and perhaps it will kill the recovery, and therefore the Fed has to fight to death here. The question is, do they even have control over the matter, or is it now completely out of hand? Because all of their quote-unquote tools are only temporary manipulation methods. They don't address the two main tailwinds pushing yields higher. And one of those tailwinds is inflation expectations. So let's see if the recent manipulation attempts by the Federal Reserve is actually working in pushing inflation expectations lower as they push or attempt to push yields to stay lower. Here it is. The surge in US inflation expectations continues unabated, the highest since 2008, meaning once again, the two tailwinds pushing yields higher are getting hotter and hotter and hotter by the day, meaning that it is just a matter of time before yields start to explode higher once again, and the Federal Reserve will have to panic and readdress their approach, etc., etc. But that will come with another sell-off in the Nasdaq. The problem is, what are you going to do? Do you have to derail the economic recovery prospects to save the stock market? The other choice is tackling inflation expectations. That's not going to happen so long as the tsunami of cocaine from the fiscal and the monetary side of the government continues to flow. What are you going to do? It's a game of musical chairs. Kick the can down the road, play the music for a little longer, but less and less chairs are going to be available when the music finally stops. I want to hear all the geniuses out there who continue to tell me, oh, you don't get it. The rise in yields don't matter, and stocks are just going to continue to surge higher. They might surge higher due to the artificial pump from the stimulus, but at the end of the day, as yields continue to go higher, he's still going to have a problem, specifically in the Nasdaq and the high-growthy names. And perhaps the end solution to all of this, instead of manipulating or trying to derail the natural rise of treasury yields, perhaps you just want to cross your fingers and say that the correction will be limited on these very high multiple names only. Meanwhile, the names that corrected already to reasonable valuations will not be touched again. That would be the best scenario for the Federal Reserve, market participants, the market, the economy, everybody. If we just have a very harsh but very limited correction in the high multiple names. The problem is there is no guarantee that it will play this way, and therefore the Federal Reserve continues to work overtime attempting to push yields lower. It's not going to play out very good. And here is yet another auction. And it came out weak in my opinion. The demand is just not there. There is more betting here from hedge funds and the likes when we look at the direct bets. And perhaps that these hedge funds have a lot of interest in pushing the market higher, and therefore they're participating more in these bond auctions to make sure to push yields lower, and therefore their technology positions in the market appreciate and get rescued at a higher price. Call me a conspiracy theorist, but how do you explain the very peculiar surge of direct bidders today? But all in all, the demand is not that good. The auction wasn't that good all in all, signaling that we will see lower prices and higher yields in bonds. And while the Federal Reserve continues to deny the existence of inflation and brush it under the rug, it is actually here and impacting American households directly, at least when we talk about mortgage rates. Mortgage rates continuing to tick higher. The 30-year now at highest level since last summer. The level still quite low relative to history, but the trend shift is worthy of noticing. And to quantify that for you, here it is from Redfin. An increase of mortgage rates from 2.75% to 3.25%, which is in the grand scheme of things not a very large increase. But here's the impact. It would mean borrowers on a $2,500 a month budget will lose $23,250 in purchasing power. And of course, we have the new stimmies. More gasoline on the fire. Just in, President Biden will sign the $1.9 trillion American Rescue Plan relief bill into law. 1:30 p.m. Eastern today. That already took place. The bill is signed. The stimmies are rolling on the conveyor belts and ready to be deposited this weekend. The big question is, how will the stimmy impact the stock market? Because we know tens of billions of dollars will go into buying stocks and call options. And do me a favor, reach into your pocket and feel for a little bit. Did you find some cash? You should. You should find a lot of it because according to the experts and the surveys, we are richer than ever. There's money floating around all over the place. There's more money floating around than dust. And according to the experts, we are richer than ever. We have so much money, it is coming out of our ears. U.S. households' net worth rose to record $130.2 trillion in the fourth quarter. Soaring prices for stocks, real estate, and other assets erased losses inflicted by the coronavirus pandemic. Do you feel rich? I'm sorry, what was that? Oh, you don't feel rich? Well, let me read the fine print for you. Because 99% of this net worth is owned by only 1% of the population. And as I've been telling you, the Federal Reserve main mandate, the secret mandate, is to protect, prop up, and inflate the assets of the wealthy. Stocks and real estate. And they did that successfully last year, and you are seeing U.S. households' net worth exploding higher. And this is a good segue to sentiment news, because we're talking about so much money. The printing went to extreme levels. And now we have so much money floating around all over the place. You just start grabbing on the air, close your eyes and start grabbing anywhere in the air. Just start grabbing. Now open your eyes and you should see cash, because there is so much cash floating around all over the place. And when you are talking about inflation and the mania in the stock market and commodity prices, etc., home prices bubble, all of that is a creation of the tsunami of liquidity. Open the floodgates, and all of a sudden, the pandemic, the worst health crisis in over 100 years, is the best thing that ever happened to all of us financially. Why? Because we got the stimmy, we got the tsunami of liquidity, our stocks are surging higher, our real estate prices surging higher, inflation, while it's going to bite us in the ass later on, for now, it is pushing the prices of our assets higher and higher by the day. Your house is worth more, your car is worth more, your furniture is worth more, the bike you have parked in your garage, that is worth more now, your underwear is worth more. Oh, wait a minute, not your underwear, but perhaps your paintings, if you have any, because paintings are worth a lot of money. But perhaps you're saying, oh, I don't have any paintings. I live in a more modern design. kind of house and I don't have any paintings, where should I look for in my assets to find value increase? Well, do you have any digital paintings? What the hell is that? Digital paintings is a fancy word for JPEG picture on your computer. Well, that is worth more now because here it is. Most expensive NFT ever sold, auctions for over $60 million. Somebody made over $60 million selling their quote-unquote digital art. You know, the SPAC generation is very easily deceived, and they do believe that everything is the future, bro. And it doesn't matter that you utilize the brain in your head before making decisions. They're attracted to these scammy deals, these get-rich-quick schemes, and they pin it under the title, It's the Future, Bro. This is one of them, the whole digital mania. And now we're selling digital art for millions and millions of dollars. And the reason is, we have so much money floating around, why not? Why not just blow the money away? We're willing to spend it on anything. Stocks higher, real estate higher, cars higher, boats higher, shoes higher, garbage higher. And now we're gonna invent other stores of value because there is so much fucking money around that we don't know what to do with. And now we have the digital phenomena. And what I'm saying here is, remember my business idea, the solar dildos that I pitched to you a few weeks ago? And the idea was to create a solar dildo company and IPO it in the market via SPAC. And who cares? We get the cash, big money anyways from the zombies who are chasing anything. We just pitch it to them as solar dildos are the future, bro. And they will put their blindfolds on and stampede running Naruto style heads first, asking questions later, buying stocks in our solar dildo company. And a lot of you asked me, well, where is the design? How come you never showed us the design of your solar dildos? And my answer is, we don't need a design because my solar dildos, they exist digitally. They only exist in your head. But I'm willing to take your money for you to have your unique digital solar dildo. There's so much money floating around. The zombies have their wallets wide open for anybody to take. Shamath, Spaccaria, any scam artist is reaching over there and grabbing that money out of their digital wallets because the zombies don't know any better. You give them money, they want to stampede on every and any lottery ticket. The question is, with all of this money floating around, are you gonna take it? Are you man enough to take it? Oh, and what about the GameStop mania? What's going on here? Here it is. Most active GME option today is an 800 call expiring Friday. And we know that call is going to expire worthless. But once again, the zombies have so much money they don't know what to do with, and they're willing to blow billions and billions of dollars on lottery tickets. And what about the junk bond mania? We talked about the outflows yesterday. Well, never mind, they're back at it once again. After a string of sizable outflows, the biggest US junk bond ETF sees its second largest daily inflow ever of 1.3 billion. It is hard to make conclusions based on the flow. Expect perhaps the big investors seem to be making bolder moves again after a month of general consensus. More in sentiment news. And here it is, for all of you wondering what's going on. Tesla up 20% in a day. The market is bouncing. All of these pussy bears who message me every day, every time the market bounces higher, they're already screaming and throwing the towel. Yes, the market is gonna bounce higher. Things got oversold. What do you think? The market's just gonna go in a straight line down without bouncing higher at all? Where is your head? Because here it is. The recent rally in the Nasdaq 100 was largely driven by hedge funds who were forced to cover their shorts, according to data from Goldman Sachs. Pay attention here. The recent rally in the Nasdaq 100 has been referred to as an oversold bounce, aided by a drop in bond yields. Beneath the surface, however, the surge was largely driven by hedge funds who were forced to pair their bearish bets to limit losses, rather than genuine interest. And I disagree a little here. I think a lot of these people made money and they're covering to book profits. But let's see what this article says. While those funds were net buyers of stocks for the fifth straight day, short covering outpaced long sales by a ratio of 4 to 1 on Tuesday, according to data from Goldman Sachs. As the spike in the tech-heavy gauge didn't reflect appetite for risk, some analysts say, pay attention, close that incognito tab, and stay with me. Some analysts say those gains will likely be short-lived. We see yesterday's move as short covering without legs, said Andrew Brenner, the head of the International Fixed Income at Net Alliance Securities in New York. Short sellers had boosted their wagers as the Nasdaq 100 tumbled more than 10% from a February record. Last week, large speculators, mostly hedge funds, were most bearish on the Nasdaq mini futures since early October, according to data complied by Commodity Futures Trading Commission. What does that mean? It means that there are bears, hedge funds in this case, who've been shorting the market since October, and they've been losing and losing and losing. And then when they saw the market sliding lower the last few weeks, they decided to cover their shorts. And that is contributing to the bounce in the Nasdaq. Those heavy bets set the stage for a short squeeze as the Nasdaq 100 surged 4% on Tuesday, the most in 4 months. Among Goldman's hedge fund clients, short covering in unprofitable tech firms helped the group hold 7 straight days of selling and score the third biggest net buying of the year. Over the past 2 days, a Goldman basket of the most shorted stocks has jumped almost 7%, more than double the return of the Russell 3000. Are you paying attention or not? Why is the Nasdaq surging higher from the bottom, rebounding significantly higher when yields pretty much the same? They didn't go lower. They stabilized, they're not going higher, but is this the reason to push the Nasdaq impulsively higher? Of course not, but this is happening due to short covering, meaning if the story remains the same, we'll go back to what we saw the last couple of weeks. The Nasdaq down, yields higher. Moving on to corporate-specific news, and we have General Electric. And here it is. You know, GE stock been rallying impulsively higher for no reason whatsoever. And today the stock was down big. And the reason is GE plans to pursue a 1-for-8 reverse stock split, which would exchange 1 share for 8 old ones. And I am baffled, to be honest with you. Why didn't General Electric surge higher upon the news of the reverse split? Because remember, last year, the Robin Hoodiots stampeded to buy Tesla and Apple after announcing their splits. Remember the whole split optimism and the donkey mentality of buying stocks based on a split when nothing changed whatsoever in the underlying company? I am baffled that the Robin Hoodiots did not buy General Electric. Oh, it was a reverse split, meaning you give me 8 shares and I give you 1 for a higher price, meaning the shares that you have are worth $10 a piece. I'll take those. How many do you have? Oh, you got 8 of them? All right, that's $80. So I'll give you 1 share that is worth $80. What is that? Oh, no. I'm not trying to scam you. I'm just trying to give you 1 share that is worth the total of the shares that you have. You got 8 shares worth $10. That is $80. I'm giving you 1 share in exchange of your 8, and that share is worth also $80. What's the problem here? And of course, the Robin Hoodiots sold GE because the reverse split. But when their cult leader, Reverend Elon Musk, told them last summer that when you split a stock, your shares, the 1 share that you have, magically becomes 8. And now you're going to make more money because you got 7 more for free. And of course, the morons, the Robin Hoodiots, stampeded Naruto style, buying Tesla stock due to the split optimism. But this time around, they're not buying it with General Electric. And speaking of the souffle, what about the souffle? Here it is. Tesla raises price of variants of Model Y, Model 3, Model S, and these of course the names of the variant types of the Tesla virus. I guess when they cut prices, they still lost market share. And to me, this is Tesla waving the white flag, saying that we're just going to stick to keeping our prices higher because lowering prices did not help in increasing market share. We lost market share anyway, so we might as well milk our existing customers for more cash. The same strategy for Apple, by the way. The only difference is that Apple has almost a duopoly and phones are a necessity. And the entry cost is about $1,000 a piece, not over 30 grand. So all the donkeys who keep telling me that, oh, Mama Kathy said that Tesla's gonna be the new Apple. Do you have your head buried deep in your ass? Because Apple, the entry price is $1,000, and now you're into the ecosystem of Apple. To enter the ecosystem of Tesla, you need to spend over 30 grand, meaning that Tesla will never be the Apple of anything. Moving on to the heat map analysis, and let's see what happened today. Once again, the outperformance is from the laggards, the deflationary trade, tech, momentum, high growth, all catching a massive bid. Whether we're talking about software, chips, big tech, Apple, Microsoft, Google, Facebook, Amazon, whether we're talking about the stay-at-home names, Zoom, Peloton. Zoom was up over 5%, Peloton up 5.5%. Whether we're talking about Tesla, up over 4.5%. These names that got whacked from the correction the last couple of weeks are catching a bid, rebounding significantly higher. Now, we discussed the reason behind the massive rebound and whether you should trust it or not. That is up to you. My job is just to present the information because we didn't see a rotation out of the winners into the losers. The inflationary trade still held pretty good. It did not catch a bid as it has been the last few days, but it also not sold or abandoned at the expense of the rally in the Nasdaq. Whether we're talking about energy, materials, financials, defensives, industrials, all having a decent closing or just modest declines. We did not see a rotation from one side of the market to the other. All of what we saw is the inflationary trade hitting the brakes. Meanwhile, we're seeing the short covering squeeze happening in the Nasdaq. And the assumption here that once the Nasdaq catches up to fix the oversold conditions, perhaps we'll go back to rewarding the inflationary trade. We have other themes going on in the market here, such as the outperformance from Boeing. And Boeing is a 100% buy. I've been saying this for days, if not weeks. The worst is behind for Boeing. It is one of the laggard names. You put your blindfold on and you buy Boeing and you go to sleep for the next 5 years, the stock will appreciate in value. And lots of funds are already stampeding to accumulate Boeing shares at these prices. Boeing closing the session about 2.7% gains. But let's dig deeper here and review the themes analysis, starting with the nostalgia name, aka the reopening stocks. Are they moving away from the reopening names? Not really. We saw a mixed picture. Some names managed to close in the red, but the majority are still catching a bid. So there is no abandonment whatsoever away from the reopening stocks into technology and high growth. What about the inflationary trade? Any rotation going on here in the market? Not at all, because once again, mixed picture here. But even with the laggards, the decliners, they lagged with modest declines. We're talking about less than 1% or so. That is not a rotation. That is just certain stocks not catching a bid today. What about the deflationary trade of tech and high growth? And by the way, there are some names here that are not tech or high momentum, such as GM, DR Horton, Dollar Tree. But the point here is to illustrate for you names that will not outperform during high inflation. Because while the first casualties are the high-tech, high momentum names, as inflation becomes a problem, a prolonged one, in the later stages of inflation, you will see utilities getting whacked, and therefore we have Duke Energy as a representative of utilities. We're going to have airlines getting whacked due to the rise of oil prices. And we have American Airlines on the list to represent the airline stocks. Dollar Tree, we discussed that yesterday. Dollar stores, their whole spiel is value, the lowest price. If inflation goes higher, they cannot pass that extra cost to the end customer. They have to eat it up and their margins will go lower. Likewise, with DR Horton and home builders in general, the higher rates will go, the higher the mortgage rate will go, and we will see a pop of the housing bubble, meaning that the demand and the hot stock for housing will come down cooling. Likewise, with GM, as inflation continues to rise higher, financing costs will become very expensive and producing cars will become very expensive in a very competitive business where you cannot pass the costs all the way to the end customers. And you have to reduce your margins. And therefore, we have CarMax as a beneficiary of high inflation. Meanwhile, GM, Ford, Tesla, etc., these auto manufacturers will not outperform under high inflation. They have other tailwinds, but when it comes to inflation itself, these names will not outperform. But we have the majority of them as high-tech, high-valuation names. And you saw massive gains across the board of over 5% in most cases. But once again, the point to illustrate here for you, from showing you the nostalgia stocks, the inflationary trade, and the deflationary trade is to show you that there is no rotation to solidify a bottom here for these deflationary stocks, meaning that perhaps the pop and the bounce we're seeing here is not sustainable. Moving on to the charts analysis. Starting with 15 minutes chart of the SPY. Gapping higher, and this is a very easy way to defeat any resistance. We talked about the level of 391 as big resistance, failing once, twice, third time, a fourth time. And the plausible way was to gap higher, and this is exactly what we got overnight after the announcement from the ECB. And you saw the SPY surging higher overnight, opened higher, catching a bid. The algos did the job. And once again, we are consolidating here in a bull flag formation that is supposed to play higher. And remember, we are at all-time highs in the SPY, so there is no resistance to look forward to. There are certain Fibonacci levels, but at the end of the day, the sky's the limit here for the SPY until and unless we see a correction in the deflationary trade, in financials, in energy, then the SPY will continue to march higher. What about the daily picture for the continuous contract of the SPY? Once again, blasting higher, impulsively reaching all the way to all-time highs. And the resistance now is 3,959 or so. That would be the prior highs, and we could defeat that tonight. In tonight's session, the SPY futures could mark all-time highs. Likewise, the MACD is curling upward, beginning to create greed impressions in the histogram, signaling an uptick in momentum. Likewise, the RSI is also trending higher, meaning that in the short term, we have a lot of momentum behind the S&P 500. Now, I showed you the weekly chart, and the weekly chart is saying that we are coming to an end of this rally. We have a bigger correction for the SPY. The question is, when will the market decide to move away or at least take profits from the inflationary trade side? Energy, financials, industrials, materials, etc. When will the market decide to take profits and, by the way, correct the overvaluation in some of the reopening trades? Once we reach this conversation, then the turn is on the S&P 500 to face a correction. But for now, the index that faced the correction is the Qs. And therefore, let's take a look at the 15 minutes chart of the Qs. And I don't have a magnet emoji, so I am using the electric charge emoji to illustrate for you that 313 is the center of gravity, meaning you're not going to pull away from this level up or down because this is the center of gravity until you have a harsh rejection from 313, and that would mean that the Qs will trend lower. But for now, we're trading higher than 313. But do we have support of 313? Did we even bother to recheck 313 for support? Or did we just perform a magic trick overnight with gapping higher above 313 without any regard to recheck with that level first? What am I trying to say to you? What I'm trying to say is that the center of gravity, 313, you're not going to be able to surpass that level without giving it the respect it deserves. You got to go down, recheck this level for support, and then rally higher. You cannot just ignore 313 and move away like this. Not gonna get away with it. Triple Qs. Moving on to the daily chart. of the triple Qs, and I'm trying to show you the Fibonacci retracement levels. And let's see where we stopped today. We stopped around the level of 318, which was a Fibonacci retracement level. We have a curling upward in the MACD, signaling a surge in momentum, at least in the short term, meaning that without seeing a significant reversal candle, we are marching to the destination of 322. But I do think that we went ahead of time here and we did not pay the 313 level the respect it deserves, meaning that the healthy way for the bounce here for the Qs is to go back, retest 313, and then bounce higher and perhaps start to catch higher Fibonacci levels. What about the unhealthy scenario? The unhealthy scenario is that you're going to continue to march higher and higher to the next Fibonacci retracement level of 322 and 68 in or around this number, and then face a harsh rejection and flushing downward once again. Moving on to the IWM 15 minutes chart. What do we see here for small caps? We have a series of bull flags leading us higher and higher and higher. Where is the next destination? It will be the upper trend line of the trading channel. And let's zoom out to a daily chart to illustrate that for you. We could go all the way and face resistance at the level where the upper range of the trading channel will meet us. In the line in yellow, we have a crossing in the MACD signaling a strengthening of momentum that could take us all the way to reach that level before we face resistance and perhaps rejection. Now remember, look at the chart and see how much gapping we did in this bounce, going higher and higher and higher overnight. This is not healthy, but we will go back to close all of these gaps, meaning that for now the IWM is trading in La-La land. It has been trading in La-La land for a while now. The difference is between now and say back a few months ago is that the trend line in momentum in the RSI is not here anymore. The momentum is a lot weaker than before. It is just a matter of time before the IWM starts to crack. The question is, at what stage will the market be ready to realize that the so-called reopening trade got out of hand, and now these reopening names are also overvalued and deserve a correction and some profit taking? That would be the moment when you see the IWM marking a top and flushing lower. What about the Dixie? What's going on here in the dollar index? Another day, another decline. The harsh rejection was very clear, and now we have support at 91, but that is not a good support. We have 90.5 as the strongest support here that we could fall down to. Now, the reversal in the US dollar is good for who? It's good for gold. But did gold rally today? Not at all. Gold is acting like a spoiled brat. What do you want to rally here, Mr. Gold? The dollar went lower. The whole Bitcoin story, a lot of people are now realizing that Bitcoin and gold are two different things, and the rise in Bitcoin should not come at the expense of gold. Okay, what do you need next, Mr. Gold? Oh, yields are rising higher? Is this what's bothering you from rallying higher? And if that is the case, then how come you, Mr. Mature guy in the room, Mr. Gold, did not rally even though in the media I'm hearing about tech stocks rallying higher due to yields turning lower? If yields are turning lower, then how come gold did not rally? Are you paying attention or not? This is once again another signal that the bounce in the Nasdaq will be short-lived. Because if yields went lower, and that is the reason behind the significant bounce higher for the Nasdaq, then why didn't gold rally higher? Perhaps gold is not a spoiled brat after all, but rather the mature guy in the room. Moving on to copper with the representative Freeport-McMoRan. Freeport is surging higher today. Once again, this is part of the inflationary trade. So if we are seeing rotation from the inflationary trade to technology, I'm not seeing it. It's not here because Freeport-McMoRan is surging higher. It's about to make a positive crossing in the MACD, signaling higher prices to come. Now, I issued this tweet a few days ago, March 5th, and I told you that perhaps this is the time to buy the dip in Freeport-McMoRan because copper is going to surge higher when we see a reversal in the US dollar at the resistance level of 92. This is exactly what happened, and now we have Freeport making a series of higher highs and higher lows, meaning that we will surpass the highs that we marked in the stock recently. Higher copper equals higher inflation equals, you know, the rest. Moving on to Bitcoin. We talked about the crossing in the MACD. We have a confirmation today. Bitcoin is surging higher and higher and higher. And to add more flavor for you, rather than just saying, oh, Bitcoin will go higher, duh, everybody knows that Bitcoin is going to go higher. Give us a price target here. Give us something to look forward to. All right, I'll give you something. Here it is. The Fibonacci retracement levels. We have the prior highs. We're not so far from that. The assumption is that we will surpass the prior highs at around 58,000. Now, can you zoom out a little bit so we can see the next destination? Yes, I can. Here it is. I'm zooming out. The next destination is in or around 68,000, meaning about 17% gain or so for Bitcoin. This is what the Fibonacci levels are saying. Whether that's going to happen or not, I have no clue. I'm just telling you what the chart is saying. Don't be surprised if Bitcoin reaches 68,000 very soon. Now, I'm not an expert in Bitcoin and cryptos from a mechanical perspective, so I don't know what's going on in Cryptomaniac land. If we have a sell-off in Bitcoin due to a mechanical reason, then I can't predict that for you. What I can do is just do the technical analysis, and the technicals are saying higher prices for BTC. What about the TNX? Yields, 15 minutes perspective. They did the whole scam overnight, working with the ECB to tell us that they're going to buy bonds like crazy, they're going to revamp the program, and they're going to buy more, etc., etc. All of that garbage is doing nothing at all to push yields lower. Yields bouncing higher right back and consolidating in a bull flag formation. They're throwing everything, including the kitchen sink, to beat yields down, and they failed over and over and over again. We're talking about billions of dollars worth of efforts to push yields lower, and that didn't happen. Use your head to figure out the conclusion. But here is the daily chart of the TNX. If I am right, this is a bull flag formation that will lead us higher in yields. Now, let's try and play the devil advocate. Maybe I'm a little biased here in my outlook. And let's take a look at the TLT and see what bond prices are saying. Once again, we have a crossing in the MACD signaling that the bad momentum is over. But in turn, are we seeing a strong uptick in momentum? A big crossing, steep crossing in the MACD? Absolutely not. It looks very, very weak, at least from the last couple of days worth of activities. We are still struggling around the levels of 139.30. And the assumption here is you're going to go once, twice, you have every tailwind behind you, from the oversold conditions to the extreme bearishness against the TLT. If you cannot bounce higher, then there are lower prices to go here before it becomes extremely oversold, and that will mean that the TNX and yields will continue to surge higher. Moving on to the VIX. What do we see here? The cup and handle formation is looking very weak, and we know that Fridays are usually crush the VIX Fridays. And if they are successful in pushing the markets higher and pushing the VIX lower, then any positive formation we have, whether it is cup and handle or otherwise, will go down the toilet. Do I believe the volatility is over? Are we going to trend lower from here in the VIX? Absolutely not. I do think higher prices are coming soon. How high, you might ask? Here it is. Higher than the prior high, meaning that we will surpass the level of 30.5. You just need a catalyst for profit taking and a sell-off in energy, financials, the cyclical parts of the market. What will trigger that? I have no clue. So for now, we're moving on to Apple. What do we see here from a daily chart perspective? We have a crossing imminent in the MACD, but the weakness is very evident. It doesn't mean that the MACD will cross and create greed impressions in the histogram and that is over. But Apple has room to go all the way to 125, and then it will face resistance. And we have a bear flag formation that is supposed to take us lower. To throw the bear flag out of the window, Apple must close the week above 125. If it fails to close above 125, then we have a similar scenario, just like we saw before with the prior bear flag. We will see lower prices here for Apple. Moving on to the souffle, Tesla. Let's see what's going on here. Holding steady here, and the oversold conditions in the RSI are pretty much solved. we're back in normal territory. What about the MACD? The crossing is imminent, signaling perhaps higher prices for Tesla are possible. And where is my target for the bounce here? Going all the way to retest the trend line, which happens to be the upper line of the channel, and that would be resistance, and then we will trade lower. Now, what about the Fibonacci levels? What do they say? Here it is. And once again, we have a lot of tailwinds here for Tesla to go higher. So consolidating in the current Fibonacci level is not good. And that would mean that the level of 718 or so is a solid resistance, and we will start to trend lower in Tesla. What you want to see as a bull here is that Tesla captures another Fibonacci retracement level, which is the next higher level, and that would be around 718 and 760. And you want to see Tesla consolidating in that range because it won't be able to just blast through all of these levels easily. The next level is very, very hard to pass. So expect a consolidation there if Tesla manages to rally higher. And then perhaps consolidating at these levels will encourage more momentum in the name, specifically after the stimulus checks, and then Tesla rallies higher. If you are bearish on the name, what you want to see is a failure, because we tested the level of 718, 720. The numbers will vary depending on your drawings. But anyways, it is between 718, 721 in or around this number. And if this is a very solid resistance, then we will reverse lower once again, meaning that we could open higher yesterday and then we see a reversal. Here is what you have to watch for as a bear. If Tesla opens lower and breaches the Fibonacci support at around 675, then the floodgates will open, meaning you have to watch 675. If Tesla fails, whether right away or after attempting to break 718 unsuccessfully, either way, breaching the level of 675 will be your signal to short. And of course, we're not talking about a 1 minute chart. You breach below the level of 675 and you start going Naruto style buying put options. You gotta use a longer term chart, 30 minutes, 45 minutes, an hour. Closing below 675 from an hourly perspective will be a bad signal for Tesla. Enough said. We're moving on to the conclusion of this video. What do we have in the economic calendar tomorrow? Yet another important series of data coming out regarding inflation. Number one, we have the producer price index, and then we have the consumer sentiment index. We know that the CPI was cooked. We will see what they do with the PPI here. It's an important reading, but it is not the most important reading because we know that the producer prices are rising higher. They're just going to hide how high it has gotten. And of course, the big question for the market here is, what is the next step? We have to circle back to the intro of this video. Two major tailwinds pushing yields higher. Number one, the economic recovery. Number two is the rise of inflation expectations. Neither one of those is going away, meaning the yields will resume trading higher once again. And you saw the capitulation from the likes of David Tepper just a few days after he said the yields have topped, meaning that we are anticipating more pain for the Nasdaq once this short covering / bounce is done. Here comes the wild card, the new stimmy checks. Will the new stimmy checks extend the bounce higher, or will the new stimmy checks actually contribute to pushing inflation expectations to rise higher, and therefore we see yields surging higher impulsively once again, and that would cause the Nasdaq to resume the correction? Once again, two scenarios. Either that the stimmy will extend the bounce before we face the inevitable of the Nasdaq going lower once again, or will the stimmy checks blow everything up right away, meaning causing high inflation expectations and pushing yields higher, and we see the Nasdaq blow up right away, and we do not get any stimmy rally? That is the $1 million question. And tomorrow's activities in the stock market will be very telling in terms of which scenario the market is leading toward, which scenario the market believes going to happen after the stimmy checks hit the market. So tomorrow happens to be the end of the week, but that doesn't mean that it is not an important day. That's all I got for you tonight, and I'll talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.